Hi everyone, my name's Daniel Kornberg. I'm a dinosaur or a lawyer from DLA Piper in the tax team. I'm going to apologise in advance for the text-heavy nature of the slides. I would have liked to have heard James's presentation before I put them together. But, you know, being a tax lawyer, I guess at the end of the day, people's limbic system just shuts off anyway as soon as they start talking. Okay, so I'm used to giving this presentation to other lawyers. So the objective is normally discussing how startups can take advantage of the tax incentives that are available to them. But instead, what it really is it's a quick and dirty. It's a real quick and dirty overview of what's out there, how you can best structure your business in order to take advantage of them. I'm not here to really give you advice on running a business. I'm just here to tell you a little bit about the hoops that you will all need to jump through if you want to take advantage of the really generous and concessional tax incentives that have been brought in by the Australian government over the last few years. So nothing signifies the government's commitment to the ideas boom and to really trying to build a viable startup economy and a hub for innovation and entrepreneurship in Australia more than the recent National Innovation and Science Agenda, which was announced in December of last year. And I'm sure you've seen these ads all over TV, all in the train stations. It's a pretty good kind of saturation campaign by the government. So basically the most significant of any of these changes that were brought in by the innovation agenda to startups is the innovation offset or the innovation tax incentive. Basically, the aim of this is to connect startup companies with investors that have the requisite funds and the business experience to help develop innovative companies. And that's something that Ilya touched on, that as a venture capital fund, you're not just there to sit there and be passive, you're there to actually help and nurture the founders and kind of give them put belief and money behind their ideas and not just to let them run with it and give them a blank check. The government's stated aim of this incentive is to help startups get through the valley of death. The valley of death, as I'm sure you're aware and have heard the concept before, it's that phase between concept and when you're actually generating revenue or received external funding from a venture capital fund or other investors. So basically what the incentives are is there's a 20% non-refundable tax offset on investment, which is capped at $200,000 per year per investor. So basically this means that investors can invest up to $1 million and receive $200,000 back at the end of the year on their tax bill. It's non-refundable, so it doesn't actually put money in your pocket if you don't have a tax liability. And then the other, which in my mind is probably the more significant part of this tax incentive, is the 10-year capital gain exemption. And basically in Australia, now that the mining boom has kind of finished and there's a reallocation of capital and a lot of that's going to tech companies, we kind of feel that this incentive, and especially this capital gains part of it, will really bring a lot of high net worth individuals into investing into innovative companies and startups. And I think that for all of you guys, that's great news, and it's a pretty good free kick from the government for both the startups and for the investors. And these incentives apply from 1st of July 2016. So qualifying investors, all types of investors qualify. Individuals, company, there's flow-through treatment for partners and trusts so that the actual incentives make it to the ultimate investors and they don't just sit in a trust or in the partnership. There's a $50,000 investment cap for retail investors, and retail investors are investors who invest on their own account, not ones who do it as a day-to-day business. And those who can take advantage of the full offset are sophisticated investors. And sophisticated investors are those who either have more than $2.5 million of assets or have made $250,000 of income over the last 2 financial years. And that's consistent with the disclosure requirements under the Corporations Act. And basically, this is the reason why sophisticated investors, as opposed to retail investors, are able to obtain the full benefit is because they're the ones with the experience. And if the government's trying to link up not just money, but the experience with the company as well, they're the investors that need to be on board. So what types of investments are eligible? So the investment itself has to be in newly issued shares in an eligible innovation company. I'll get to that shortly. Basically, transfer of shares aren't eligible because the company doesn't get the money. The economic benefit of the transfer goes to the transferor of the shares. The shares also can't be acquired under an employee share scheme. But one thing which we find very significant is that convertible notes can be eligible, provided on their conversion and when the shares are issued, all of the boxes are ticked and the criteria are satisfied. And in our experience, and Joel Cox spoke to you all before about my firm, DLA Piper. We do a lot of work with venture capital funds and with startups. And we've found that there's a lot of venture capital funds, both domestically and internationally, who their preferred method of investment is a convertible note. So a qualifying early stage innovation company. Hopefully every single one of you who have got a startup in a company will satisfy this. But there's 2 limbs. It's a company incorporated in Australia that satisfies the early stage limb and the innovation limb. So the early stage limb is basically about the age of the company. Effectively, the company must have been incorporated or added to the Australian Business Register in the last 3 years. If it hasn't, and it was incorporated longer prior to that, then it and all of its wholly owned subsidiaries could not have had more than $1 million of expenses over the last 3 income years. So that basically allows people who have just taken a shelf company that's been sitting there for a number of years and still be eligible for the offset. There are also monetary thresholds that apply to make a company eligible, and that's they can't have total expenses of $1 million or more in the prior income year, and they need an assessable income of $200,000 or less in the previous income year. And I called someone from Treasury the other day because the way that the legislation is drafted, and yes, this is the limbic stuff, and I know you're all shutting off, but basically, if you incorporate let's say you incorporate 2nd of July, and then you 6 months later, someone invests in your company. Technically, you don't have a prior income year. But they said that the intention of the legislation is that even if you haven't had a previous income year, if you're incorporated in that year, you can still remain eligible. So the innovation, and this is the fun part. So there are 3 ways in which a company can satisfy this limb. The first one is self-assessing against principle-based tests. The second one is applying its circumstances against objective tests. And the last one is seeking a ruling from the ATO. So the self-assessment limb, it's got 5 factors that a company needs to be genuinely satisfied that it actually does all of these things. And having a look at these factors, I'll just read them out very quickly. Being genuinely focused on developing a new or significantly improved product, process or service for commercialisation. Having a business that has high growth potential. Being able to demonstrate scalability of its business, having potential to address a broader than a local market, and having potential to have competitive advantages. These 5 factors, for mine, seem like the ordinary things that venture capital funds and investors are often looking for in a company. So, if you're a company and you've just started up and you've got this great idea, you probably satisfy all of these 5 things if you're going to be able to close an investment round anyway. So you've got also the objective test slim. The objective test slim is basically measurable criteria that you can, that the company can satisfy and have absolute certainty that they're an innovation company. So basically, these are a few examples of the table in the legislation, something like a third party that is not an associate of the company has previously invested $50,000 more, that will get you 50 points. In order to be an eligible innovation company, you need to get 100 points from that table. And then the last way you can satisfy this limit is through a private ruling. This is for companies that don't satisfy the other two tests but still believe that they're innovative. So basically, in a private ruling, what you do is you write a letter, your lawyers, your accountants, anyone, writes a letter to the ATO and basically says, please use your discretion, we think we're innovative because of X, Y and Z, despite the fact that we don't appeal to a broader local market or something similar. And this ensures that truly innovative companies won't miss out. And then there's a few other things to note. The legislation gives power to the government to actually issue regulations in respect of this law. And basically, the reason for the regulations would be if the government wants to prohibit a certain sector or industry from applying. So basically, let's say with Brennan's example, with Law Advisor, the government might come out and say in the regulations, you know what, we don't think there needs to be any innovation in the legal sector, or we don't think the legal sector is inherently innovative. So we're just going to cross that off, and anyone who falls into the legal sector, bad luck, you can't be an eligible innovation company. And then what Brennan can do is he can be like, well, that's crap. What we're doing is truly innovative. So that's when he would apply to the Commissioner for a private rule. Also, the general anti-avoidance provisions apply. This basically stops people from entering into contrived or artificial structures with a dominant purpose to obtain these benefits. And also there are company reporting requirements. So if your company is going to deem itself to be an eligible innovation company and you're receiving investment, you need to report that to the Commissioner and say, we've issued X amount of shares under this. You don't need to say the names of the investors or anything like that, but you just need to say what test you use to deem yourself to be eligible. So I'll just run through these ones very quickly. So the innovation statement brought in some other important tax changes. One was further concessions to the early stage venture capital limited partnerships regime, which is a very tax concessional regime to investors. And they've just kind of made it even more concessional. Now taxpayers are allowed to self-assess the effective lives of certain intangible assets. Previously, things such as patents had a 25-year effective life prescribed by statute. Now a business can actually say, you know what, we only think this is valuable to us for 12 years and depreciate it accordingly. And then the last one as well is in order to improve access to losses for companies that have changed ownership, they've introduced a similar business test, and that used to be the same business test. So employee share plans. Just quickly, hands up who here, your company has got an employee share plan. Yeah, and under the startup rules? Okay, well, basically, in 2009, the Labor government brought in employee share plan changes that were really non-concessional, and from 2009 until July last year, basically any company that wanted an employee share plan would come to us and say, how do we get it out of these rules because they're frankly terrible. Employee share plan changes in other jurisdictions really were a driving force behind startup economies. So what happened last year was they brought in the startup rules, and to qualify under the startup rules, you need to satisfy all of those things. But if you do, and the employee holds the shares or the options for 3 years, they're taxed on capital accounts. So what that means is, the employee will be entitled to a 50% capital gains discount on the sale of those shares, and that's really concessional. And basically, in the last 8 months, since July last year, we've seen almost a renaissance of startups looking for employee share plans because they're a really good way to to remunerate founders and early employees. So then the other tax incentives that have been introduced a little while back were R&D concessions, often called the lifeblood of startups. And the reason for that is because you basically get if you have turnover of less than 20 million, you basically get a refundable tax offset on any eligible R&D expenditure, which is a pretty broad, R&D expenditure is a very broad concept. And at the end of every year, you actually get a tax refund in cash from the ATO. And so that allows you to kind of, that allows you to have a working capital and cash flow, even if you're not generating revenue. Then also, before Parliament at the moment, there's crowdsourced equity funding. There's a crowdsourced equity funding bill, which makes it a lot easier now for startups to source equity from just the general population through, similar things to like Kickstarter and that, but receive equity in the company. So that's the end of the quick and dirty. And I'm glad that no one I can see is asleep. But basically, I'm not sure if we've got time for questions, but I'll be around for the next little bit. So anyone who wants to ask me a question, do we have time for questions or?
Maybe one.
Sure.
Is anyone working on a platform for crowdfunding for equity in Australia?
Not that we're aware of. It's still in bill form, and it's quite limited. Like, for instance, individuals can only contribute up to $10,000. Eligible companies can only raise up to $5 million, and that's really good for really small, early stage companies. There's a million platforms around the world. There's
Equities.
Yeah, Equities, and I can't remember. There's an Israeli one as well that does really well. But basically, it'll also allow Australian people to invest in the in equity crowdsourced equity funding off international platforms.
Just a quick one, probably a yes or a no answer.
Yep.
Pre-going to seek VC.
Yep.
Does a company, can you lodge this and apply for this and then go to the investor meeting and say, right, I've got this certification or I've got this qualified?
Yeah.
So you do all this up front?
Do all this up front. And because it's a principles-based test, you kind of either have it or you don't. The reporting requirements are after the fact to the ATO, so you just need to be satisfied that you fit that criteria and market yourself to any investors as, there's great tax incentives for you to invest in us because we are an innovation company.
But there's no certification or there's no documentation back from the ATO to say, well, yes, we qualify for this?
No, unless you get a private ruling, and a lot of the principles-based tests that are available in tax law, anything that's uncertain, companies will often seek a private ruling just so that they do have that in paper. Yeah. But I think, like I said, I think that if you're getting VC funding, you probably do tick those 5 boxes anyway.
And if you qualify for the R&D rebate for 5%, you probably automatically qualify for this?
Not quite, because you can have R&D expenditure that's not commercialising, based on commercialisation and things like that. But in the objective test, a lot of them do refer to R&D expenditure and certain amounts, and that will give you points. So if you do have R&D expenditure, it's more likely that you'll satisfy the objective tests.
Awesome, guys. Do we want to give a big round of applause to Daniel? Thank you so much.